So this is level 3 study session 7 and reading 19 fixed income part, liability driven and index based strategies. It's a extensively large reading, so you have to be slightly patient, but it is equally interesting. It primarily pertains to the situation which you will encounter when you are acting as a fund manager for liability driven portfolios. Now, what are liability driven portfolios? So, liability driven portfolios are where you have to meet certain liabilities and you have to manage a portfolio so that you are able to accurately meet those liabilities, right? So it is different from a typical portfolio which you generally encounter, for example fixed income mutual funds, etc., where there is no liability but the funds are being managed and the returns are being distributed. Now, what are the examples that you can think for liability driven? Let's say there is a defined benefit pension plan and the company has to pay a certain pensions to their employees at the end of a certain period, which means this is a liability. Now, in order to manage that liability, the company will be funding it, right? And after funding it, it has to be managed in a way that whenever these liabilities mature and in the way it matures, you have sufficient assets to pay off those liabilities, right? So this is what is liability driven fixed income portfolio. Very interesting. And if you really want to make a career on the fixed income side, particularly on institutional side, then this is a very, very critical reading for you. So let's get started. So on the liability driven portfolio, there are three kinds of commonly used terms which you should remember. One is the asset liability management. So both assets and liabilities are managed parallelly because both change in response to interest rates, right? Then second is liability driven investing, which is what we will see here and which is similar example of what I spoke about on the defined benefit pension plan. And then the third is the asset driven investing. The asset driven investing example could be a leasing company, which is a lot of floating or fixed rate financial assets, and they might need to structure their liabilities to meet the characteristics of those assets, right? Now you must be thinking, how does liability driven investing applies to individuals? So it might apply to an individual. For example, let's say you are somewhere around 34-35 age group and you want to retire in around by the end of 50 years, and you by the end of 50 years you want to build a retirement corpus which will help you manage the retirement. Now this is a liability, right? And in order to manage this liability, how do you manage your assets in a way that at the end of 50 years or by 50 years you have a sufficient corpus to meet those liabilities? So this is an example that we can think of on the individual side. So now let's discuss the types of liabilities here, and very important concept before we jump onto the more deeper parts. So there are four types of liabilities that you should remember here, and they are mainly characterized by two main parameters. One is known future amount, and the second is known payout states, right? So the first one is where you know the future amount also and you know the future pay date also. So an example of that could be a typical option free bond, right? You know the future amount and you know when it will mature. Second kind of is when you know the future amount but you are not certain of the payout date. What's the example? Example could be a callable bond, a putable bond, because you don't know when would it be called or when you might want to put it off. Another example here could be a term life insurance. So in a term life insurance, the insurance company does not know the payout. When would it happen? It knows that it has issued a policy for, let's say, a 1 crore term plan for a certain individual, but it does not know whether it would have to pay or not, and if yes, then when, right? But having said that, there are now actuarial models and probabilistic models which help the insurance companies ascertain the payouts at the end of each year based on a probabilistic model. Now the third one here is, you don't know the future amount, you know the future date, right? So what are these? So these are mainly the floating rate bonds, right? Because they are linked to a certain benchmark and you don't know how the benchmark would move. Therefore, you don't know what would be the future amount. But of course, you know the future payout date. And the fourth one is, you know both. You don't know both, sorry. You don't know both. Now, this could be an example of, let's say, property insurance. Okay, another example could be a casualty insurance. Because you don't know both of the things in terms of how much the damage would be and when the damage would be. So let's see now how we can immunize a single liability portfolio before we move to more complex concepts of immunizing a multiple liabilities portfolio. So here in a single liability portfolio, the most simplest form of immunization, we have discussed it earlier, is cash flow matching, right? So since it's a simple liability and you know the amount which the liability is accrued for, so you just have to match the cash flows for that particular duration of the liability. Okay. So what is the simplest form to do that? The simplest form to do that is buying a zero coupon bond, right? And the amount that will actually accrue at par for a zero coupon bond should be equal to the amount of that particular liability. Correct? So with a zero coupon bond, there is no cash flows to reinvest, and there is no price risk also. So there is no price risk, no reinvestment risk. And important point to remember is that these bonds should be default free or risk free. So you're sure that you will meet that particular single liability. Now, before we move to discussing more, the yield curve changes, etc., which can occur even in a single liability portfolio, and how do you immunize that, let's discuss a few basic concepts or revisit a few basic concepts to understand the more changes to the yield curve much better. So first concept is macro duration. You must have heard it multiple times, but just to revisit the concept here. So what is macro duration? It is the weighted average time until the cash flows of an instrument are received. So remember, whenever we talk about macro duration, you have to consider this as a seesaw, wherein we have one side we have a price risk and the other side we have a reinvestment risk. And how do they balance each other? What is price risk? Price risk is the bond moving in opposite direction to the yield curve changes. Basically the price of the bond moves in opposite direction to the yield curve changes, and therefore any increase in yield will cause a decline in the price. What is reinvestment? Now the bonds will give regular coupons or regular cash flows, and how do you reinvest that, or the rates prevailing at that time determines at what rates are you reinvesting. If the rates are declining, then of course you are reinvesting at lower rates, which means that is a risk. How do they balance each other is what is determined by the macro duration. Now let's talk about the other concepts. So other than macro duration, there is modified duration, right? So how do we define modified duration? It's a simple formula. This is macro duration by 1 plus R, right? So how do you, how do you understand, particularly in the level 3 curriculum, macular duration and modified duration will be used interchangeably, and you need to understand the context where these can be used much more favorably, or where, at particular point, which one will you prefer over the other. So when we are talking about immediate price change of the instrument, any situation which involves immediate price change, for that modified duration is a much more better concept to use. But when we are talking about the measure of time for some immunization techniques, that time macular duration is much more favorably used. So an important concept to remember here is portfolio IRR, which is very, very important when it comes to asset liability management. And pay just close attention here, because there is a very, very important concept or a theme which you will have to remember for the entire concept or entire subject matter of the asset liability management or liability driven and index based strategies. This is particularly related to portfolio IRR. Now, what is portfolio IRR? Let's say you are trying to match a single liability, and you are constructing a separate portfolio of bonds to manage that or to meet that single liability. Now, what would you do? In the initial cases, what would you do is you would actually try to determine a portfolio level IRR initially. What is portfolio level IRR? So portfolio level IRR is nothing wherein we try to find out a rate wherein the portfolio market value equates the rate at which all future cash flows are discounted, and they should be equal. So effectively, it is the initial IRR that you will earn on the portfolio. And always it is important that remember, and the theme that I was talking about is the theme that the goal of the immunized portfolio should always be to earn the initial portfolio IRR. Okay, what typically quite a lot of students and subject matter experts miss out is they try to match or they try to earn the average YTM of the bonds. Remember that initial YTM that you determine is nothing but the initial portfolio IRR, but with the yield curve changes, the YTM will be subject to change. But remember, when you are talking about immunizing a liability or asset liability management, our goal is always to earn a portfolio level IRR. Very, very important, initial portfolio level IRR. This you should remember throughout the term and all throughout your fixed income experience. So now let's try to understand how do we immunize a single portfolio liability and what are the risks involved in the same. So let's say that this is the chart, and this is where the liability is actually occurring. Okay, I have termed it as M, medium. Okay, now one thing that we can do to immunize this is, let's say we are constructing a barbell portfolio. Okay, so we are having two assets here. Okay, or two assets, barbell portfolio, and one with a low duration and one with a high duration, to effectively match the initial portfolio IRR, which equates the present value of the liability. So what are the conditions that we need to fulfill to immunize this portfolio? I'll write down these conditions right here. Right. So first is we need to make sure that the initial value of the portfolio, which is the asset side, right, should be equal to the discounted present value of the liability. Okay. So let's say if the liability is materializing here, you bring it at 0, and then you make sure that your initial value of the portfolio is equal to
discounted present value of the liability. That's one condition that we will need to fulfill, right? Second condition that we need to fulfill is the durations are matching. Okay, so the liability duration is equal to the asset duration. And remember here, liability duration is just, since it's a single liability, so it's just the time at which that particular liability is maturing, and asset duration, it's a barbell portfolio, so it would be a weighted average. The third condition which is typically matched is it's made sure that the portfolio convexity, which is the asset level convexity, exceeds the convexity of the single cash flow liability. Okay, so I'll write it as LC. So this is an important one because we will discuss why this is ensured, that the convexity of the asset portfolio is slightly exceeding the convexity of the liability portfolio. Okay. Now let's take a scenario. Let's take a scenario wherein we have this yield curve currently. Okay, so this is a liability, and these two are the two sides assets, with one with a lower duration and one with a high duration. Now let's assume that the yield curve changes parallelly and it rises upwards. So let's say this is the new yield curve which is being formed. Now how does this impact you? Okay, now the rates are increasing, right? So the rates are increasing means what? The value of the portfolio is going to go down, right? So both, now we will discuss both the liability side and the asset side separately. Now since the rates are increasing, even the liability side of the portfolio will decrease, right? And since the rates are increasing, even the asset side of the portfolio will decrease. Now the important point to remember here is, will these two decrease be equal to each other? No. Right? Why no? Because we are comparing a single cash flow liability to a barbell asset portfolio, which reacts differently. Now herein where the concept of convexity comes into picture. If you are ensuring, at the time of immunization or at the time of initial immunization of the portfolio and making sure that the conditions are satisfied, you are ensuring that the asset convexity is greater than the liability convexity. And why are you doing that? The reason why we are doing that here is, what will happen is, the new portfolio, what will happen here is that the liability side will decrease, which means that it is good for you, right? But the asset side will also decrease, but the decrease in the asset side will be lower than the decrease in the liability side, which means that you are benefited overall in terms of immunization. At the end of this event, you will have a lower liability initially than initially it was to meet, but you will have a relatively slightly higher asset to meet that liability. And that is why it is made sure that the conditions of initial immunization, the convexity of the asset is made slightly higher than the convexity of the liabilities. A similar analogy can be formed when the rates decline. Now the rates decline, which means that it's beneficial for the portfolio. But remember, although it's beneficial for the asset side of the portfolio, liability is also increasing. But here, even in this case, the increase in liability is going to be lower than the increase in the asset, which means that overall you are benefited, right? So to summarize, these three are the key pointers which you should always remember. One is, you need to match the duration of the asset portfolio with the liability portfolio. Number two, The initial value of your asset portfolio needs to be equal to the discounted initial value of the liability portfolio. And number 3, your convexity of the asset portfolio should be higher than the convexity of the liability portfolio. Please remember these 3 conditions for immunization purposes. Now let's discuss the concept of what we call as structural risk, and it's a very important concept because it denotes the structural risk to the overall immunization strategy, because the yield curve change might not be parallel. Okay. Now before we deep dive into that, I would like to highlight one important formula for convexity which has been mentioned in the curriculum. Although not expected that there would be a question asking you to calculate convexity, but it is important to note this formula just in case. All right. So now let's go back to the concept of structural risk. Now going back to the concept of structural risk, let's discuss this with an example of steepening twist. So if you see the chart on the right hand side, that's particularly this is the actual original yield curve, and right now after the yield curve change, it is steepening. So what you see is on the longer end of the curve, the rates are increasing, while the shorter end, the rates are decreasing. No change on the middle side. So here, since this was the initial liability, so no changes to the liability. However, since the longer end of the curve is increasing, the rates are increasing, so the value of the portfolio is declining, right? However, there is a positive effect on the short-term side, but the long-term effect actually exceeds the short-term effect, which means that in a steepening twist here, the present value of the assets is declining, while the present value of liabilities is remaining the same. Now what that means is, that your immunization initial immunization conditions that you had satisfied while starting the immunization does not hold true, and clearly the assets value is decreasing. Now this is where it's a time to rebalance your portfolio, because there is a structural risk. And what is the structural risk? Structural risk that the value, the cash flows of the assets portfolio that you receive might not be sufficient to meet the liability, right? So you need to rebalance the portfolio. Now let's look at this, the second chart, which is called as a positive butterfly twist. Now again here, see, this is the original yield curve, and what's happening here is the rates are changing on all the 3 durations. So even on the liability side, the rates are declining, right? Which means what will happen is the value of the portfolio will increase. So present value of liabilities is going to increase, right? Which is not good for your portfolio. Here again, what is happening is both the ends of the curve for the asset side, the rates are increasing, which means the value of the portfolio is declining. So present value of asset side of the portfolio, that is declining. Now what that means is you are getting hit on both the sides. On the one side, the liability that you are supposed to be met, that value is increasing, and the assets value is declining, which means that there is a dual loss here, and you need to effectively see and rebalance the portfolio here as well, right? So now what it means is that it is possible that the strategy can succeed in this positive butterfly twist, but it can succeed only if the portfolio IRR increases enough versus the decrease in liability discount rate. Okay, so that's the condition. So portfolio level IRR increases sufficient enough to counter the decrease in the discount rate of the liability. Now if that doesn't happen, then it creates a significant structural risk. So in the curriculum, what you need to remember is there are it has been divided into two sections. One is, of course, there is a structural risk to the portfolio, which is dependent on how the yield curve changes, and it's been classified into a normal structural risk and a significant structural risk. Significant is when you are hit at both ends, right? So on the liability side also you are hit, and on the asset side you are hit. So now let's recapitulate what we have understood. Now, similar to steepening twist, we have flattening twist, which is just the opposite of steepening twist. Flattening twist, and similar to positive butterfly twist, there is a negative butterfly twist, just the opposite of this. Now, so let's discuss what are the conditions that are very important to immunize a single portfolio liability. And remember this, a lot of essay related questions would come from here, and you need to remember the conditions very well. So first condition is the initial market value of the asset portfolio, present value of assets, should be equal to or greater than the present value of liability. That's the first condition that you need to satisfy. Second condition is the Macaulay duration of the portfolio should be equal to the Macaulay duration of the liabilities. And remember, we discussed modified duration only relevant for immediate changes to the interest rate to the portfolio, but when you talk about immunization, Macaulay duration is a more favorable and more used concept. Number 3, you need to minimize the convexity of the asset portfolio to avoid any dispersion of cash flows around the liability, right? So you need to minimize the convexity. Now remember, earlier we discussed that an example where the convexity of the assets portfolio was greater than the convexity of the liability portfolio. That is just to ensure that the asset portfolio slightly benefits from the yield curve changes. When the changes on the liability side and the asset sides are largely similar. But overall, in order to minimize the dispersion of cash flows, minimization of convexity is the important criteria. So let's say if you might be given a question wherein there are two portfolios for assets A and B, and all are similar in nature in terms of Macaulay duration and present value of assets, etc. But what is different is the convexity. One convexity is very high, in one it is okay. You might be given a convexity of the liability portfolio, or you might not be given. Here, in order to select these out of these two portfolios, you need to make sure that the convexity, you select the lower convexity for two reasons. Number one, to minimize the dispersion of asset cash flows around the liability, and number two, of course, convexity comes at a cost, right? So this largely concludes the overall concept of immunizing a single liability. Here there is one more concept which is mentioned in the curriculum, and which you might have remembered from the level 2 curriculum, which is nothing but the BPV. If you remember, BPV is nothing but a value in terms of the modified duration. So it is modified MD into V into 0.1. Sometimes you might be required to calculate BPV in order to compare the BPVs of the portfolio. You might not be given a Macaulay duration or the otherwise also, so you need to just remember the basis point value in order to make sure that you calculate the other thing if it is required. So in the next session, we would discuss how we can immunize a multiple liability portfolio, and the overall discussion that we had so far becomes a foundation for that next level of interesting discussion.